You want to know the truth about this business of trading. It's simple, but it isn't easy. That's the part most fellows never get through their heads. The market will give you 1,000 setups every week if you go hunting for them, but how many are worth your money? How many are worth the risk? That's where the real game lies. Trading is not about taking every swing the market offers. It's about standing still, waiting, and then striking when the odds have lined up so heavily in your favor that it feels almost foolish not to act. Have you ever noticed how hard it is to do nothing when prices are moving? That's where discipline comes in. That's where most men fail. I spent years learning this lesson the hard way. I made money and lost it, then made it again and lost it once more. The same pattern repeated until I realized that the only trades worth making were those where I had the wind at my back, where the odds were tilted so far to my side that the danger was less than the opportunity. Do you see the difference between acting because you are eager and acting because the situation is ripe? Most don't. They trade for the sake of being in the market, as though sitting in a position proves something. But the wise trader knows that inactivity is a position too. Patience is a position, and often it is the most profitable one you can hold. You might ask, what makes a setup high probability? It is not some secret formula or magic indicator. It's a combination of conditions that tip the scales. Think of it like sitting at a poker table. You don't play every hand. You wait for the hands that are worth betting on. A high probability setup is the ace in your pocket. It's the alignment of price, trend, volume, and sentiment in such a way that the market almost declares its own intention. But tell me, when you look at a chart, do you see what is happening, or do you see what you hope will happen? That's the difference between a gambler and a trader. The market is a great teacher if you're willing to listen. Price action speaks louder than opinions. It whispers clues in every tick, in every bar, in every reaction. A stock that resists falling on bad news is telling you something. A stock that rallies on heavy volume and refuses to give back the gains is telling you something. Are you listening, or are you too busy talking yourself into a position? That's the test, and it's one you'll face every day you choose to trade. When I talk about high probability setups, I mean the times when the path forward is made clearer by the past action. A breakout after a long consolidation, for example. Why does that matter? Because when prices have rested, digested, and worn out both buyers and sellers, the first move out of that range is usually the real move. The market has been coiling, and now it's ready to spring. Doesn't it make sense to bet on the spring when you can see it being wound tighter each day? But still, many traders rush in before the move, guessing, hoping, willing the breakout into existence. Then they wonder why the stock goes nowhere and they end up whipsawed. The high probability play is to wait, to see the move confirm itself, and then act. Wait for proof. Proof is expensive, yes, but it's cheaper than hope. Another sign of a high probability setup is the trend itself. Never forget, trends exist because the majority has chosen one direction. Fighting them is a fool's game. If a stock is in a clear uptrend, making higher highs and higher lows, with volume supporting the moves, do you need a crystal ball to tell you what side to be on? Yet time and again, I see men trying to pick tops, calling reversals, betting against strength, because they can't stand the thought of being late. But what is worse, being late, or being wrong? I'll tell you from experience. The market pays well for patience, but punishes vanity every single time. Ask yourself, when you study your chart, do you see the footprints of the big operators? Because that's what you're really hunting for. The public doesn't move prices. The public reacts. It is the large interests, the professionals, the institutions, who leave their tracks in volume and structure. When accumulation is underway, it shows. When distribution is underway, it shows. Are you looking for those footprints, or are you just staring at candles without understanding what they mean? A high probability setup is nothing more than aligning yourself with those who are stronger than you. It's letting the tide carry you instead of trying to swim against it. Risk, of course, is the other side of this coin. No trade is certain. Every position carries danger. That's why the smart trader always calculates the risk before stepping in. A high probability setup is not just about potential reward, it is about the balance of risk to reward. If you stand to gain 3 or 4 times what you risk, and the chart supports the move, that's a trade worth taking. But if you're risking $1 to make 50 cents, tell me, is that wise? It isn't. That's not trading, that's handing your money to the market on a silver platter. Would you make that trade in any other business? Of course not. Then why make it here? The mind is your greatest enemy in trading. It tempts you to act when you should wait. It fills you with fear when you should be bold, and boldness when you should be cautious. How often have you seen a stock climbing steadily, only to convince yourself you've missed the move? Then you jump in just as the top is forming. Or you see a stock falling, you tell yourself it's cheap, and you buy only to watch it go cheaper still. That is human nature, and it is the very thing you must fight against. High probability setups don't demand you chase or guess. They come to you if you have the patience to let them. The market, in its essence, is a weighing machine for human emotion. Fear and greed pull it this way and that. But underneath those emotions lie patterns that repeat, because human nature does not change. Have you ever noticed how the same chart formations appear over and over, no matter the decade or the market? That's because the players change, but their weaknesses don't. A breakout looks the same in 1905 as it does today. A failed rally has the same fingerprints now as it did when I was cutting my teeth in the bucket shops. That's why chart reading is not some superstition, it's a study of human nature itself, laid bare in price. Let me tell you something important. The big money is not made in the small swings. It's made in the big moves, the campaigns where you align yourself with a trend and ride it for all it's worth. High probability setups are your entry into those campaigns. You don't build wealth by scalping for pennies here and there, wearing yourself out, and paying commissions to every broker in town. You build it by identifying when a market is ready for a real move, and then having the courage and patience to stay in it. Do you think Rockefeller made his fortune by selling too soon? He didn't. He held. He accumulated. He let the trend pay him. And that is exactly what the trader must learn to do. Still, the temptation to take small profits is strong, isn't it? You see a stock up 2 points, and your first thought is to grab it before it vanishes. But in doing so, you rob yourself of the very gains that pay for your losses. Do you realize how few truly high probability setups you will encounter in a year? Why waste them by cutting them short? A trader must learn to distinguish between noise and signal, between the ordinary wiggles of price and the real moves that matter. When you're in a true setup, let it work. Protect yourself with stops, yes, but give the trade room to breathe. High probability doesn't mean no drawdown, it means the odds favor you if you let time and trend do their work. And yet, how often have you seen a man jump from one system to another, one method to another, always searching for the perfect formula? There is none. The secret, if you can call it that, is to stick with sound principles and practice them with consistency. Have you mastered patience? Have you trained yourself to wait for the best setups and ignore the rest? Or are you still chasing every flicker of movement as though your life depended on it? I tell you, the market will eat alive the man who cannot control himself, but it will reward handsomely the one who knows when to sit tight and when to act. Money management is part of this, too. Never risk so much on a single trade that a mistake wipes you out. A high probability setup can fail. It does happen. That's why the wise trader risks little on each attempt, but stands ready to press his advantage when the market proves him right. Do you pyramid your position when the trade goes your way, or do you treat every move as a gamble, in and out without structure? That's the difference between speculation and mere betting. A high probability setup is not just about the entry, it's about how you manage it, how you add to it, how you defend it, and how you let it pay you. Think of trading as a business. Would you open a store without knowing your costs, your margins, your demand? Of course not. Then why trade without knowing your risk, your targets, your edge? A business survives because it takes only the opportunities that offer profit and avoids wasting capital on unproductive ventures. Trading is no different. Every dollar you risk is inventory. Every setup is a chance to deploy that inventory. Would you waste it on second-rate goods? If you wouldn't in business, then why in trading? High probability setups are your prime merchandise. Save your capital for them. I'll tell you another truth: the crowd is usually wrong at the critical moments. That's why the majority never wins in the market. They buy at tops because it feels safe, and they sell at bottoms because it feels necessary. A high probability setup often appears just when the crowd is most convinced of the opposite. Are you willing to buy when everyone else is fearful? Are you willing to sell when everyone else is greedy? That's the real test. But you don't do it blindly. You do it because the chart, the volume, the behavior of price tells you the tide is shifting. That's not contrarian for the sake of it, it's intelligent speculation. What you must develop is a mind that sees clearly and waits patiently. Do not clutter your charts with 100 indicators. Do not drown yourself in news or opinions. Focus on the essentials: price, volume, trend, support, resistance. That's all you need to see high probability setups. Everything else is noise. Do you think the great operators of my day needed 10 oscillators to tell them when to buy? They didn't. They read the tape. They studied the action. They knew when the market was strong and when it was weak. Keep it simple. Keep it sharp. Keep it focused. And above all, remember that this game is not about being right on every trade. It's about being right on the big ones. You can be wrong half the time and still make a fortune if your winners are larger than your losers. That's why high probability setups matter. They tilt that balance. They ensure that when you are right in a big way, and when you are wrong, the damage is small. Isn't that the very definition of sound speculation? A breakout after a long consolidation is one of the highest probability setups you will ever find in trading, and yet most traders misunderstand it, misuse it, or fail to wait for it. The market is a mechanism of movement and rest, expansion and contraction. It does not trend forever in a straight line. It surges, then pauses. It runs, then breathes. That pause, that period of congestion where prices seem to do nothing, where bulls and bears fight in a narrow range, is not dead money. It is preparation. It is the quiet before the storm. The longer a stock builds its base, the more meaningful the breakout tends to be when it finally comes. Doesn't that sound like common sense? Pressure builds, energy coils, and when it is released, it carries further. That is why a confirmed breakout after consolidation is far more reliable than a guess or a premature entry. The first thing you must understand is why consolidation happens. A stock rallies, then runs into profit-taking. Early buyers cash in, latecomers hesitate, shorts probe the market, and the price settles into a range. Volume dries up. It looks boring, doesn't it? That boredom drives out the impatient. But beneath the surface, strong hands may still be accumulating. They use the range to absorb supply. They use the quiet to position themselves without attracting too much attention. Can you imagine what happens when they finally have all they want, when sellers are exhausted, and when the stock is tightly held? The slightest demand can lift prices sharply, because there's nothing left to sell at those lower levels. That's the essence of a breakout. Now, most traders do not wait for confirmation. They see a stock moving toward the top of its range and they rush in, hoping to catch the move early. But hope is not a strategy. How often have you entered before the breakout, only to watch the stock turn back down into the range, chewing up your capital and your confidence? That is the trap of anticipation. High probability trading demands proof, and proof costs something. Yes, you may pay a slightly higher price when you wait for confirmation, but you also buy safety. Would you rather pay a premium for certainty or a discount for hope? That's the decision that separates a professional from an amateur. A confirmed breakout is not just a price poking above resistance for a moment. It is a decisive move, backed by volume, sustained beyond the intraday noise. Volume is crucial here because it tells you whether the move has conviction. If prices rise but volume does not expand, the breakout may be false. But when prices surge and volume surges with them, that is the market speaking in a clear voice. That is demand overwhelming supply. Do you see why volume is the companion of price in every meaningful move? Ignore it at your peril. Think about the psychology of the participants trapped in a consolidation. Every trader who bought at the top of the range is waiting to get out at break-even. Every trader who sold short at the bottom of the range is praying for a decline. When the breakout occurs, those sellers are forced to cover, adding fuel to the rally. Those who hesitated, those who sold too soon, those who doubted, all rush in. This chain reaction, this unwinding of positions, is what gives a breakout its power. You are not just buying strength, you are buying the forced buying of others. Isn't that exactly the kind of tide you want to ride? The duration of the consolidation matters. A base built over weeks or months carries more weight than one formed over a few days. Why? Because time wears out traders. The longer a stock sits still, the more the weak hands give up. The more complete the absorption, the more explosive the breakout. When you see a stock that has gone nowhere for months, and suddenly it pushes through resistance with authority, you are looking at one of the most powerful setups available. How many traders overlooked it during that long sleep? How many were shaken out by boredom? And how many will now scramble to get in when the move is obvious? That's the reward for your patience. But remember, not every breakout succeeds. The market loves to deceive. False breakouts are common, and they are designed to punish the greedy and the reckless. How do you protect yourself? You wait for confirmation, you measure volume, you place your stops wisely. A true breakout should not collapse immediately back into the range. If it does, you must cut your loss without hesitation. The beauty of this setup is that the risk is usually small. Your stop lies just below the breakout point. If the move fails, you are out quickly. If it succeeds, the potential reward is many times greater than the risk. That is the definition of a high probability trade. Now consider how this fits into the larger market context. Breakouts in strong overall markets tend to have more follow-through than those against the prevailing tide. A stock breaking out during a broad bull market is likely to attract more capital, more enthusiasm, and more institutional support. On the other hand, a breakout in a weak market may struggle. Do you align your trades with the tide, or do you try to fight it? The difference can decide whether your breakout becomes a fortune or a frustration. There is also the matter of relative strength. A stock that shows strength when the market is weak, holding near its highs while others are declining, is a prime candidate. It tells you that something is happening behind the scenes, that demand is outweighing supply, even when conditions are unfavorable. When the general market turns up, such a stock is often the first to break out, and it runs the farthest. Are you paying attention to which stocks resist decline? They are the leaders waiting to be recognized. A confirmed breakout is not just an entry signal, it is often the beginning of a campaign. That is where the real wealth is built. Too many traders take a quick profit after the first surge, but the seasoned operator knows that the first move is only the start. The breakout signals that a new trend may be underway, one that could last weeks, months, or even years. If you sell too soon, you rob yourself of the very profits that justify the patience. Isn't it better to ride the wave as long as it runs, pyramiding your position carefully as the trend proves itself, rather than grabbing a few points and moving on? That is how fortunes are made. Let us speak for a moment about discipline. Waiting for a breakout after consolidation tests your patience more than almost any other setup. The market moves elsewhere, other stocks surge, and you feel left behind. But discipline means waiting for your pitch, not swinging at every ball. A consolidation can last far longer than you expect, but when it resolves, it pays. Can you stand to watch and wait without forcing a trade? Can you accept the boredom as the price of admission to a high probability move? That is where character shows itself. You may notice that some breakouts fail because they are too obvious. When every trader sees the same level and piles in, the market has a way of punishing the crowd. That is why subtlety matters. The best breakouts often occur in stocks that are not on everyone's radar, in bases that look dull and uninteresting. By the time the public notices, the professionals are already in, and the move is underway. Are you hunting for those overlooked setups, Or are you chasing what everyone else is watching? The former pays better, though it requires more effort. Risk management, again, cannot be ignored. You never assume that a breakout will work simply because it looks good. You always define your risk, place your stop, and accept the possibility of failure. The high probability setup does not guarantee success, it only tilts the odds. That tilt is enough, provided you handle it correctly. A series of small losses, offset by 1 or 2 major breakout successes, can build your account steadily. Do not fear being wrong. Fear staying wrong. When you study charts from history, you will see this pattern repeat again and again. Consolidation, breakout, trend. It is the rhythm of the market, the heartbeat of speculation. Whether it is railroads in my day or technology stocks in yours, the principle is the same. Human nature creates the range, human impatience gives up during the wait, and human greed fuels the breakout. That is why this setup has stood the test of time. Do you think it will ever vanish? Not as long as people trade, for people do not change. The lesson is simple, but it must be lived, not just learned. You must train your eyes to spot the bases, your nerves to wait them out, your discipline to demand confirmation, and your courage to hold when the move comes. This is not easy work. It is harder than chasing every flicker of price. But it is the work that pays. If you call yourself a trader, then mastering the breakout after consolidation is not optional. It is essential. The trend is your ally, and yet, time and again, traders treat it as an enemy. They think they know better than the market. They look at a strong uptrend and convince themselves it must be near its end, so they sell short. They look at a clear downtrend and tell themselves the bottom is in, so they buy. But the market doesn't care what anyone thinks. It doesn't move because you or I believe it should. It moves because forces larger than us, supply, demand, capital flows, and human emotion are all at work. The trader who ignores the trend is like a man trying to row against the current of a mighty river. He exhausts himself, he makes little progress, and eventually the current takes him under. Isn't it wiser to let the current carry you, to ride it rather than resist it? Think of it this way. When a stock is in an uptrend, making higher highs and higher lows, with volume coming in on the advances and drying up on the declines, that stock is showing you strength. It is telling you that demand outweighs supply. Isn't that the side you'd prefer to be on? Why would you stand in the way of such evidence? Yet so many traders pride themselves on calling tops. They want to be the first to predict the reversal. They crave the recognition of saying, I sold it at the very high. But recognition does not pay bills. Profits do. And the profits go to those who respect the trend, not those who defy it. Human nature rebels at the simplicity of following trends. We think it must be more complicated, that there must be some trick, some secret only the insiders know. But the greatest operators in history built their fortunes by riding trends. They didn't invent them. They didn't fight them. They didn't question them. They saw them, they recognized them, and they acted in harmony with them. Do you think it is a coincidence that the largest profits always came from holding in the direction of the prevailing move? Of course not. That is the essence of speculation, aligning with strength, avoiding weakness, and letting the market itself carry you. Consider the mental strain of going against the trend. If you short a rising stock, every tick higher adds to your pain. If you buy a falling stock, every tick lower gnaws at your conviction. The trend works against you, wearing you down, forcing you to question your decision. Contrast that with the calm of trading with the trend. When you buy in an uptrend, pullbacks are expected, not feared. When you short in a downtrend, rallies are selling opportunities, not threats. Which side of that equation would you rather live on day after day? Trading is hard enough without adding unnecessary struggle by fighting the dominant direction. Now, a trend does not move in a straight line. It zigzags, it retraces, it tests your nerves. That's where traders get shaken out. They forget that corrections are part of the trend, not the end of it. In an uptrend, the stock must rest. It must pull back to attract new buyers, to shake out the weak hands. These pullbacks are the very moments that offer high probability entries if you have the patience to wait. But what do most traders do? They panic at the first sign of weakness, sell their positions, and then watch in frustration as the trend resumes without them. Or worse, they short the pullback, mistaking it for a reversal, only to be crushed when the stock moves higher. Do you see how failing to respect the trend leads to loss after loss? The temptation to call reversals is strong because human beings love to imagine they can outsmart the market. They see a stock climbing and they say, "It's gone too far, it must come down." But too far is a relative term. A stock can always go further than you think, both up and down. The trend continues until it is broken, and not before. Guessing the end is gambling. Following the trend is trading. Which one do you want to be known for? Another point worth considering is that trends often last longer than anyone expects. When a company grows earnings year after year, institutions keep buying. When an industry captures the public's imagination, demand swells for months or years. When fear grips the market, selling pressure doesn't vanish overnight. These forces are persistent. They create waves that carry prices far beyond what seems reasonable. Reason may tell you the stock is overvalued, but as long as the trend is intact, overvalued can become more overvalued. Reason may tell you a stock is cheap, but cheap can always become cheaper. Isn't it more profitable to acknowledge reality than to argue with it? Of course, following the trend requires discipline. You must define what trend means to you. Is it higher highs and higher lows? Is it a moving average slope? Is it relative strength versus the market? The exact tool matters less than the consistency with which you apply it. The danger lies in abandoning your definition the moment the market tests your patience. A single bad day doesn't end a trend. A sudden spike doesn't confirm a reversal. You must distinguish between noise and signal, between natural fluctuations and true changes in direction. Can you resist the urge to overact? That's the challenge. Risk management is also tied to the trend. When you trade with the trend, your stops are placed in logical spots, below the recent swing lows in an uptrend, above the swing highs in a downtrend. The trend itself gives you structure, a roadmap for where you're wrong. Trading against the trend offers no such clarity. Where do you place your stop if you're shorting a stock that keeps making new highs? Where do you cut your loss when you're buying a stock that keeps setting new lows? Without the framework of the trend, you are left guessing, and guessing is a costly business. Think, too, about the mental comfort of aligning with the prevailing direction. The market rewards patience when you're on the right side. You can sit still, you can let your profits grow, you can add to your position carefully as the trend confirms itself. That's how wealth accumulates. But if you're always fighting the trend, you're forced into short-term trades, always jumping in and out, always anxious, always at war with the tide. Do you want your trading life to feel like constant struggle or like riding a steady current? The answer should be obvious. Historical charts are filled with lessons about the power of trends. Look at the great bull markets of the past, the great bear collapses. Those who respected the direction made fortunes. Those who fought it went broke. It wasn't about intelligence, it wasn't about prediction, it was about humility before the facts. The tape told the story. The chart drew the picture. The trend carried the message. All the trader had to do was listen. But most men were too stubborn, too proud, too eager to be clever. They lost their money trying to outguess what was right in front of them. There is also the matter of compounding gains. When you follow the trend, you give yourself the chance to pyramid, to increase your position as the market proves you right. Each add-on is financed by profit from the earlier ones. That is how small accounts grow into large ones. That is how a campaign builds. But you cannot pyramid against the trend. You cannot add to a losing fight and expect to survive. Only by going with the current can you build in such a way that your risk remains under control while your profits expand. A trader must learn to love the trend, to welcome its persistence, to embrace its logic. The market does not owe you reversal points. It does not owe you turning tops or bottoms. It only offers direction, and it pays those who align with it. Have you trained your eyes to recognize the structure of a trend? Have you disciplined your mind to stay with it through the noise? Have you accepted that the simplest approach, following the path already chosen by the market is also the most profitable? These are the questions that decide your fate as a trader. Risk to reward must always be stacked in your favor before you take a trade, and yet this is the principle most traders ignore in their hurry to act. They see a price move, they feel the excitement, and they rush in without asking the most important question: what do I stand to gain versus what I stand to lose? That ratio, that balance between risk and reward, is the foundation of every high probability setup. Without it, even the best-looking chart can turn into a trap. Have you ever asked yourself why two traders can look at the same breakout and one profits while the other loses? It is often not the setup itself, but the way they measure and manage the risk to reward that makes the difference. Think about this as though you were running a business. Every dollar you commit to the market is capital, and every trade is an investment of that capital. No wise businessman would spend $1 to make 50 cents. He looks for situations where his return justifies the expense. Why should trading be any different? Yet most traders throw money into the market with no regard for whether the potential gain outweighs the possible loss. They chase, they hope, they pray, but they don't calculate.